Hi guys, this is Dan from the Investment ABC, your guide to financial freedom. And in this video, I want to discuss the state of the current market and whether we will see more upside potential or if we are on our way to rollover soon. The S&P 500 vaulted higher from its lows in March of this year of around 2,200 points to around 3,710 points. This is an increase of 59%. The Nasdaq even rallied more from 6,630 to around 12,600 points, which is a 90% increase. Despite the pandemic and the lockdowns of the economy, stock prices began their increase after the central banks and governments around the globe began to stimulate the economy with QE and stimulus checks. The Federal Reserve began to increase its balance sheet from around 4.2 trillion in March to around 7.2 trillion US dollar as of now. It is funny that it took the Fed decades to get the balance sheet to up to 4.2 trillion US dollar, but only 6 months to double it. The new created currency units found its way through bonds into other asset classes like stocks and real estates. Many investors positioned themselves in anticipation for the liquidity tsunami, which ultimately came and brought the dead stock market back to life. Many of these stocks turned into zombies, totally detached from the fundamental value and balance sheet. Many companies had to lay off employees during the lockdowns to survive and take on a lot of debt. Unemployment rates skyrocketed from 4.4% in March to 14.7% in April. During that time, the government extended unemployment benefits with an additional $600 per week, and many people were making more money than before with the job. Furthermore, the government handed out PPP loans to almost any company that was applying for it, making sure everyone had enough to survive. This was the time where millennials living with their parents with no job prospects discovered Robinhood and the stock market. Many began to start their journey to transform into a professional investor. At the same time, bond yields were at record lows and some value stocks yielded more than 5% in dividends. Smart money was anticipating the effects of the liquidity injection and started to shift heavily into the stock market. The Robinhood crowd followed the smart money, and both were buying every dip until now, boosting the stock market to absolute record highs, surpassing the pre-pandemic highs in February 2020. EV stocks were the most popular among the younger generations, creating many wealthy investors. Stocks like NIO more than 20x their investments from the lows, and after hiking up valuations to insane levels in the EV space, retail investors are chasing hot SPACs and IPOs now. Companies like DoorDash, Airbnb, or C3.ai opened up more than 100% in their first day of trading, with valuations of up to 70 times the current sales. This is insane when you think that not long ago, a price to sales multiple of 10, even in a hot growth stock, was considered pricey. What this shows me is that a lot of new inexperienced investors are flooding into the stock market who don't know how to value a company. They're not looking to buy a business but want to gamble and get rich quick. These are the same people who are the first to complain when the sentiment turns. First they complain, then they get frustrated, then they get confused, and in the end they get scared and sell their shares at much lower prices. The current sentiment reminds me of the dot-com bubble, where retail investors were also chasing IPOs and internet companies to make a fortune. One of my favorite illustrations is the following. It really pictures how the market in general functions. If you want to be a long-term successful investor, you have to know where you are currently in this cycle. The problem with an extremely overvalued market is that you don't know when exactly the flood of new retail investors slows down or stops. The market can be longer in hyper overvaluation than most of the experienced investors believe. In my opinion, patience is the key. I know it is frustrating getting outpriced by 10-year-old Robinhooders, but when the market turns, it will turn down violently. The main driver of this asset bubble is the Fed and the ultra-low interest rates. And here lies the difference between this market and the stock market during the dot-com bubble. Back in the year 2000, the interest rates were roughly 6.5% when the bubble started to burst. This time around, we have 0% interest rates. That means bonds and cash aren't an alternative for even conservative investors. Bonds and cash are at the moment as risky as overvalued stocks, but stocks, on the other hand, are tangible assets similar to real estate and also give you a dividend yield of 2 to 3% on average. That is the reason why this stock market rally is so resilient and strong, because there is no alternative at the moment. If we have a look at the monthly chart of the S&P 500, we can see that the current bull market started in March of 2009 and continued until now. The crash because of the sickness was a fake breakout to the downside of the longer term trend line, which was bought up very quickly by investors. All the time this bull market has slowly increased, there were very few retail investors involved. Only in the last 2 to 3 years, more and more retail investors entered the market, and only recently in 2020 the party for the retail public really has started. The participation of the retail investors normally mark the end of a long-term bull market, which is accompanied with a huge blow-off top where valuations reach totally insane levels, and smart money uses this opportunity to get rid of their holdings and move into bonds. Unfortunately, bonds aren't a viable option for the smart money, so the capital might stay longer in the market than most investors believe. The problem now central banks are facing is that they can't let the asset prices deflate in an orderly way, but on the other hand, they can't let them overheat also. That is the reason why they have to let corrections of the magnitude of 20 to 30% happen before injecting more liquidity to inflate further. I think we will soon see one of these bigger corrections happen where the S&P 500 will test its long-term trend line one more time. This correction will be most likely triggered by a wave of bankruptcies as soon as the stimulus programs and support for small businesses end, mostly due to the fact that we have a vaccine now or because the sickness will disappear by itself sometime next year. At that point, we have to wait how the reaction of the Fed will be. If they unleash a second bigger tsunami of liquidity or if they let gravity do its magic. Unfortunately, our current economy is so distorted that we don't look at business fundamentals for our decision to purchase stocks anymore, but what the Fed is doing. Everyone should know that this won't go on forever and that something will break the system. You can't continue this game forever because at some point the poor will be so poor that they can't take it anymore and violence will erupt everywhere. Before that happens, the current monetary system will be redesigned to start the game of Monopoly one more time. Those with real tangible assets will have a clear advantage over those without it. Unfortunately, investors who are buying stocks or other assets due to fundamentals may be priced out for a longer period of time or even until the change in this monetary system happens. I said there will be corrections of 20 to 30% of magnitude, but this still wouldn't make stocks fundamentally cheaper. We have to adapt to find a strategy to still profit in this environment without risking too much. Capital is not flowing evenly into all assets. Most of the money is flowing right now into growth stocks. So there are industries that are neglected or hated. I have been buying heavily into oil stocks where companies like ConocoPhillips, Lukoil or Gazprom were really undervalued. Furthermore, I have bought AbbVie at around $85. These are some companies with good dividend payments if you can buy them at a good entry price. I have bought my oil stocks for a swing trade and have sold them recently again. Furthermore, I'm trying to find growth stocks with 10x potential, which are still unknown by the wider market. Examples of these are NIO, Meituan-Dianping or TED Lifestyle and Wellness. You can check out my videos on these companies and when I bought them if you haven't heard about them yet. I'm trying to buy these stocks as early as possible to get the maximum amount of return. When these stocks double, I sell a portion of these growth stocks to get my initial investment back. The rest is sleeping until the broader market discovers the stock and the price reaches its potential. If you are new to the stock market, please find yourself a strategy and don't jump into the market without a plan and an exit strategy. If you like this video, hit the like button to support the channel, subscribe for more stock picks and macro updates on the broader market, share and comment. Bye guys, and see you in the next one.